Let's come back to Nigeria, where the Group Chief Executive Officer of the Nigerian National Petroleum Company Limited, Mele Kyari, has announced that the NNPC as a corporation grew its profit after tax from 287 billion in 2020 to 674 billion last year. Kyari, who disclosed this at a press conference in Abuja today, said the 2021 profit was contained in the group audited financial statement of the oil firm for the year ended December 31st, 2021. Let's take a listen.
In 2019, we rolled out deliberate policies and initiatives aimed at reducing costs and eliminating losses while adopting technology to entrench transparency, accountability, and performance excellence across the various functions that support our business operations. This is in line with our substantive Minister of Petroleum Resources, who is also Mr. President, for us to make sure everything we are doing is made known to our shareholders, that we must be transparent and we must be accountable to the shareholders, and we are following this through. Since then, we began to see transformational impact of these policies and initiatives of NNPC's performance. We have recorded significant improvement in our financial performance over the past 3 years, turning up the curve from losses to profits. In September 2021, Mr. President graciously approved the publication of the 2020 NNPC Group Audited Financial Statements, in which
a total of $46.1 trillion was wiped off global stocks and bonds since November of last year. That's according to an investment note published by the Bank of America late last week. But since 2022 started, the Nigerian stock market has reported some 4 trillion naira in value, even as volatility continues across the global markets. Joining me to chat to the markets, the Geregu power listed on Wednesday, and the change of guards at the NSIA is Johnson Chukwu, the CEO at Carry Asset Management. Welcome back from the holiday Monday, sir. Thanks for coming through on the show. Let's start with the market. What's your outlook on the market as we get October started and move into the final quarter of the year?
Thank you, Bossy, for having me, and happy Independence Anniversary in arrears to Nigerians. My outlook for the capital market in the last quarter of this year is that the equities market will likely see some downward trend because of tightened liquidity in the economy. You recall that the Monetary Policy Committee at the last meeting in September tightened further monetary policy rate by increasing the MPR to 15.5%, 150 basis point increment, and then also increase the cash reserve ratio to 32% and 32.5%. And these factors, these two major increases, will mean that available liquidity in the economy will shrink, price of credit will increase, and cost of borrowing will increase in effect. And it then also means that investors will now begin to switch from equity instrument to fixed income instruments. So that the impact of that will be that the equity market should likely see some bearish run in the coming months, or in the month of October and the subsequent months, unless policy ratios change again in November, which should be the last MPC meeting for the year.
Okay, so the global stock markets have seen 1 year of major sell-off even in this year. How did the NGX reported 4.15 trillion jump between January and September?
Yeah, you have to recognize the fact that because of FX liquidity, or lack of the fact that our currency is not floating, we have some level of silos effect when it comes to economic policies or economic impact of global events. The reason is this: if you look at what happened globally, you saw that the Euro Reserve Bank, the Bank of England, the European Central Bank, virtually all the central banks in the world increased rates and tightened liquidity, which made fixed income instruments more attractive for investors. And that was why we saw a decline in almost all the global bourses in the first 9 months of this year. Added to that is the war in Ukraine, which heightened inflation pressure, heightened risk of the global economy is going into recession, and investors in situations of uncertainty will naturally move to what they call safe assets, and that is dollar, bond, and dollar instruments. So that's basically what has happened, and that's why you saw sell-off in several global capital markets. But in the Nigerian case, we do not have the latitude to invest elsewhere in case you have returns that are more juicy or more attractive elsewhere, because you don't have the FX liquidity. We don't have the convertibility of the currency constrains Nigerians from only focusing their investment in the local market. And in the local market, at that point, you have to weigh the return on fixed income instruments vis-a-vis the return on equity instruments. In the early part of this year, equity instruments gave dividend yields of some of them more than 10%, and dividend return on fixed income instruments were quite low until recently. If you recall, until recently, some 365-day bills were trading at just about 4.5% T-bills rate, or at best 6% T-bills rate. But that which was far below the return on dividend yield. And that was what motivated investors, particularly institutional investors like the PFAs, to be heavy on equity instruments. That's why you saw that market appreciation in equities. Another factor we have to take cognizance is that Nigerian quoted companies actually did well last financial year compared to what they did in 2020 financial year. The simple reason is this: 2020 was a year that the global economy was still in a recession. There was a year of lockdown as a result of COVID. 2021 was a time when the economies were opened up and business activities actually jumped up in terms of turnover, in terms of profitability of several quoted companies, particularly the financial services industry, the consumer goods industry, and several other sectors of the economy, including the building material and industrial goods sector. So what happened was investors had to take a bet on the fact that these companies were going to give juicy returns, which happened in the first half of the year. And that's what propelled such level of market growth or market performance in the first 9 months of the year.
So we've got one very big listing coming on tomorrow, Geregu Power PLC, bringing about roughly 600 billion naira market value into the NGS. Give me your outlook on this particular stock, the listing, and the wider ramifications for the power sector and the economy.
Well, let me start from the wider ramification. The fact that we're having Geregu being listed simply means that other Gencos, other generation companies have also the prospect of getting listed. And that will give them access to funding. Remember that because the Nigerian power sector has not achieved economic sustainability, or has not achieved achieved economic value in terms of becoming profitable. So some operators in that sector, in the value chain, have been taking the hit. The Gencos are not being paid on time, but they need to pay for gas. But getting listed will mean that they will have access to a pool of funds. Many of the Genco acquisitions were bought with credit, but now they're going to refinance those credits with this foray that Geregu is making, because it will stimulate and encourage other operators in the Genco, in the generation business, to come into the market and access long-term credit or long-term fund, not necessarily long-term credit. Of course, they can they can issue bonds, but they can also issue equities. That, for me, is the most important thing we're going to see from this listing of Geregu on the exchange.
All right, we're grateful for your time tonight and your insight as always. Johnson Chukwu, licensed dealer and CEO at Carrier Asset Management. Thank you. Enjoy your evening.